Um, Hello, everybody, and welcome to our live stream. Hello, Siddharth.
Hi Sonam. Hi everyone. Hope everyone's having a great Sunday morning.
We're doing this after a while, right? Did we do it last month?
We did one in end of December, early Jan, I think,
But we
for
didn't
the new
do it.
year, but not since then.
Oh wow, that's really weird.
It's nearly a quarter now, I think.
Oh, so then this was long overdue, right?
Yeah.
Okay, awesome. So should we wait like for a couple of minutes for more people to join in?
Yeah, we can give them maybe a minute or two, and then we can probably
Okay.
get into it right after that.
So we floated a form, right, Siddharth? So what were the questions
We
that
did,
you?
yeah. I
So what?
will just open the form here as well.
So what
I
were
think
the
we've got a few
questions?
quite a few questions. Yeah, but I'll just show them. We'll also be taking questions on the stream directly. So if you have questions, please feel free to drop them
Yes.
in the chat.
Maybe we can start, right? Like, are you putting up the
Yeah.
questions? Okay.
Should we take the questions after the presentation? Yeah,
What
that's
do
what
you
I
think?
was thinking initially.
I just thought that just give me a gist of what type of questions are there so that we can focus on that rather
Uh,
than.
so broadly, I think standard stuff, which is similar to um, in terms of what's happening in the market in terms of performance.
Mhm.
One is on the US, the war that's happening. What are the likely outcomes in terms of people's portfolios, but also like commodities, gold, etc. Like, are those things that you should be looking at potentially? And then there are questions around rebalancing, etc. as well. So that's the broad gist.
And okay, so we'll do specific questions later. Maybe we'll start with covering a presentation on geopolitics and earnings, which are the big things, right?
Yeah.
Okay, so I'll just start presenting my screen. Okay, here we are. All right. Uh, so we'll start by talking about obviously the big shock, right, which was the global crisis in terms of the Iran, Israel, and US war, right? So while the ceasefire has been announced, but I think a conclusion hasn't happened yet, right? I think there was bombing in Lebanon that happened last week, and I think today, if you're following the news, I think there's no conclusion to the talks in Pakistan that happened, right? Are you following that?
I don't know about today morning. I was a little busy today morning, but yeah, have been following it pretty actively. Just
Yes.
it's funny how there's a lot of misinformation still out there. I think in terms of the negotiations.
Yeah, I think so. I'm sort of following it along on Twitter, which is not the best source, I guess. But it seems like the Iran guys are not sort of uh, coming down on the Gulf of Hormuz and the nuclear part, right? Which the
Yeah,
US
yeah,
sort of
yeah.
push. But yeah, see, I think even though there is a conclusion in sight in some sense, and the ceasefire has been announced, there is a big impact that has happened, right? So 11% of the global oil supply is impacted, 20% of LNG supply is offline, right? And
Yeah.
and it's still not back, and it will take, I think, years to come back, right? If you look at India macroeconomics, I think macroeconomically India is at a decent space. You saw the RBI policy; they've kept the stance neutral, right? GDP is pretty robust, and we do have sufficient foreign reserves, right? So I think in terms of if you look at it from three lenses, there's been a significant valuation correction. There is decent sort of liquidity, but yeah, sentiment is also coming back, right? We saw a big sentiment hit, and we've seen recovery from that sentiment over the last week, right?
Correct.
So, if you were to look at it objectively, I don't think it's the worst time to sort of be in the market, right? So I have a quick wait. So quickly, if we look at the fear and greed index, right, which is something that we track, let me just open this for you. You'll see that you've seen a significant sort of a recovery, right? We're still not at the best sentiment. We're still at one of the worst sentiments, right, historically. But it went really bad, and you're seeing a recovery from there, right? So if you go, so yeah, I think we're seeing some recovery happen, and these type of situations are in fact the best times to allocate, right? Another
Correct.
thing to look here would be the earnings, which is something that we'll cover extensively in the next few slides. Yeah, so I think so here we talk about the global energy complex. You know, there's been a big impact, like we said, right?
Yeah.
Huge impact in
So
oil,
I think
LNG.
one thing to note is also that I think at least for India, about 40-50% of our fertilizer also comes from
Yes,
this region, and we import a majority of it. And Kharif season is coming up soon, so that's something to think about as well.
definitely. And I think there are few other chemicals like sulfur and all which come from this region, right?
Correct. Yeah. Yeah. Yeah.
Have across the board.
Yeah.
Yeah, and I think the ceasefire did meet with a big reaction, right? So if you look at, I'll quickly open my trading view chart that I look at all day. Is that you saw a big rebound, right, from the drawdowns, right, that have happened, and this is significant, almost from 22,000 to 24,000 move, right? But it is still not done yet, right? There is a panic premium which went down, so the panic maybe came down, but the structural impact, right, it's still not over, right? uh,
Yeah.
the underlying structural issues, right? For example, even Qatar would take time to sort of rebound. The Gulf countries will sort of take times to rebound, and obviously Iran has been impacted, right? Yeah, and I think, see, this is the time frame of normalization, the logistics. If the ceasefire happens, which it hasn't actually fully happened yet, the logistics would sort of recover quickly, right? Which means that the ships start moving, but on the upstream side, right, you would see that the reservoir dynamics, the field maturity, which is the manufacturers of these oil and gas, have seen big impact, right? The refineries, etc. So they will take a long time, to maybe months, to recover, and the infrastructure that has been impacted on LNG, etc., will take even larger time. So the war definitely has had a long-term structural impact on that region, which is something that we have to remember, correct? But yeah, like, see, looking at India's macroeconomic sense, we see that there are threats. There is energy price, there is trade route disruption, inflation. But despite that, you have a few things that are protecting us. One is the GDP has been strong. There is 55% of the GDP is driven by domestic demand. There's a war chest in terms of forex reserves, and then policy makers and infrastructure is also sort of really pushing to protect us from the external volatility, right? So which is a positive note for India. Even in the recent times, you see that the RBI has kept the rate neutral, right? And they did talk about the inflation risks and the liquidity risk, and I think the speculation is that once the ceasefire is over, you'll see a rebound in the EM currency, which we did see, right? I think rupee has rebounded quite a bit, right?
Correct. Yeah.
From, I think, 94 levels, almost 95 levels, it went to almost 92 levels. So there's been a decent rebound, and I think if the ceasefire sticks, you can see more rebounded.
Yeah.
So I think see, in terms of risk that are there in the macroeconomic front, you have the oil shock, which is the big risk, and then like you said, the trade disruptions on fertilizer and other maritime routes can be a risk. And then I think right now, even on the monsoon front, right? I'm not sure if you guys are following that, but this time there's a El Nino factor that could come, right?
Correct. Yeah.
We can probably write something about it as well, so that
Actually,
but
yeah, yeah, that could be something. Yeah.
yeah. So El Nino, I think this time this expectation of lower rainfall, and if all these three things come together, right, that could lead to high inflation and destruction of the current account deficit, which is a you know uh, key risk that still could happen. But you're seeing some positive moves from there as well, right? Now let's talk about the drawdown. Like we saw almost 13% drawdown in the Nifty, right? Huge amount of FII outflow. We were looking at FII outflow recently. So FII seem to have bought nothing in the Indian market. They seem to have sold a lot of banks and financials. They sold a lot of autos also. And primarily that could be because of their asset allocation decisions, right? They're not taking exposure in risk assets given the geopolitical uncertainty. Yeah, but see, if you look at wars, right? Typically, we've seen that on an average, these different wars have had around 10 to 12% correction in the overall market, right? And these are recent wars. These do not include, the historic wars. And you would see that from such drawdowns, whenever this thing is over, you see sharp recovery. So on an average, 12-month return after a correction are around 40%, right? And 24-month return are even stronger, right? So I think that is one thing to look forward to. Typically, when such deep drawdowns happen, the market reacts with a strong momentum driven recovery, which is where we think that some of our strategies can really shine, right? um, so right now, if you look at it, the current shock is like event driven shock, right? And we these are different studies of drawdowns. So that I think you wrote about this as well, right?
On the event-driven shock, I write on it? I don't know.
the, the,
I'm not sure.
the types of
This is.
drawdowns, I think you wrote something about it, right?
Oh yeah, yeah,
So,
yeah. We did write about it. Yeah, yeah. I think we did. Yeah, correct.
yeah. So there are three types of drawdowns that could happen. One is event driven, which is something that we are seeing right now, which was like COVID, and then other short term crises. But and then those corrections lead to a strong recovery. On the other hand, there could be liquidity shocks, right? For example, 2008 was a liquidity shock. There was a crisis in the global financial market, right? Which led to liquidity drying up, and you see uh, those drawdowns are typically slightly larger. And then there are structural drawdowns, where what that means is that these massive multi-year drawdowns where there is domestic earning failure and governance failure. So which is something what we see right now is this is an event driven drawdown, which are typically short term. And when these
Correct.
drawdowns
Yeah.
are over, you see strong resurgence over the next few months, next 1 month to a year, right?
Correct. Yeah.
If you look at the Nifty metrics right now, you'll see valuations are a very attractive number, right? Growth trajectory is between 20 to 14%. I think this time we are going to expect a muted earning, right? There's nothing
Yeah.
fantastic that we expect. Uh, but yeah, I think there are a lot of pockets of interest which are attractive right now. Now let's look at what has worked and what hasn't worked in this drawdown. I think what's obviously the tactical pivots like IT pharma, right? They have been slightly cushioning towards the drawdown, right? I think they like IT has been surprisingly robust, right? Pharma has also been positive. On the other hand, you've seen realty, auto, consumer durables give you strong numbers, and these are driven by actual demand, right? Domestic facing demand. um, yeah, I think the recommendation, if somebody is looking to invest right now, see, I think I talk to people who ask me, when is this over, what do you think about the market? I think, see, this is the best time to actually invest, right? I think nobody would argue that, when you're seeing the market present you such high discounts, right, that could be actually a good sort of time to enter. But I think there could be, you could do it in a tranched way or a staggered way. I think there should be an immediate deployment of certain portion of your money, right? And then you could wait for maybe a volatility buffer, right? There would be volatility, I think, going forward. Once you see volatility escalate, maybe sometime soon, you could add more. And I think whenever the confirmation happens that the Gulf of Hormuz has fully opened, that could be the last point where you can fully allocate. So, what we really think is this is a great time to enter. You could do it in a staggered fashion, but yeah, I think these opportunities are very rare, right? Where you see
Correct.
such
No,
deep.
I think, yeah. I think last time we probably saw something similar would have been maybe the 2020
Yeah,
crisis.
right. And I think especially the value investors. Like there are certain investors, like I read Pulak Prasad's book, right? So
Mm-hmm.
they typically they'll wait years and years. So they like a company, but they want to buy at a certain valuation, and they want to buy it for the long term. So they'll typically wait for such discounts in the valuation, which is when they buy, right? So typically these valuation corrections are a great opportunity to buy. So yeah, I think yeah. So this is the bottom line is that best investments are made when confidence is scarce, right? Just give me 1 second, sir. Sorry. Yes. So best investments are made when the confidence is scarce, and you know you have to just be patient. There is a temporary panic that we'll recover from. Obviously, there will be long-term impacts of the war, but the domestic facing sectors are interesting, and you can find great opportunities in those sectors. So so talking about domestic facing sectors, and where do we invest, right? So I want to go over the earning piece quickly, right? I think earning season has
Just
just started, right?
Yeah, the earnings season has just started, but I think, like you said, we're expecting a relatively mute
Yeah, we are expecting a
performance
muted.
this year.
Yes,
Sorry, the
we'll see.
presentation is just loading for me.
Oh, is it?
No, no, on my on Canva on my end. Sorry.
Okay. Yeah, so you're seeing some, this earning season is going to be muted, and there are reasons for it. One is geopolitics. There's a macro drag due to the U.S. private credit slowdown, and then crude oil is impacting input cost, right? So you would see EBITDA squeezed down, right? Margins would squeeze down. And here's a picture of what sectors could do well, right, in this earning season. So what you see is, very strong expectations from automobiles, metals, retail, some NBFCs and insurance companies, right? On the other hand, you see muted sort of expectation from IT, banking, FMCG, cement, capital goods, and you see actually negative expectations from oil and gas, consumer durables, healthcare, agriculture, cement, specialty chemicals, right? And you see these sectors which are impacted by the crude price will see the worst sort of earnings coming on, right? And sectors where
Correct.
you which are linked to maybe the domestic factors, those are where you're seeing positive action. So we'll just quickly cover a few sectors here, right? So talking first about the financial companies, banks, NBFCs, insurance, AMCs. I think banks will be very stable, right? You will not see. I think the numbers will be attractive, right? There is still, you're seeing credit growth, you're seeing deposit growth, but there is a pressure on net interest margins. But still, I think these companies will be. pretty stable, right? They can be the stable core of people's portfolio. In terms of NBFC and insurance, you'll see a mixed performance with strong AUM growth, and we're seeing credit growth, which is positive for a few NBFCs. AMCs, I think it's very attractive right now. We actually have now two AMCs in our PMS portfolio, and I think even despite this correction, you see that the AMC book is at the peak right now, right? So I think that, and the SIP phenomena is not stopping. So I think AMCs, wealth managers, brokers, these are attractive places to look at. Then about automobiles, did we write something about autos that recently?
Maybe like a month or so back, we had written some stuff, I think, on autos, EVs, etc.
So in the auto sector, I think tractors are seeing a volume surge driven by GST cuts, subsidies, and healthy Rabi sowing. You're seeing consumer vehicles also show strong growth. So I think you're seeing two wheelers, private vehicles also do relatively well. So we've had exposure to, I think, a lot of these companies like Ashok Leyland to Hero Motoco to Asian Motor, etc. at different point in time. And ancillaries is something where our strategies are picking a lot of ancillaries, right? I think we have pretty high number of ancillaries in our portfolio in the auto, tire, battery, and the EV infrastructure makers, right? I think I presented on Lumax Tech some time back, right? So Lumax
Yeah.
Tech is one of the companies that creates the whole panel for a EV, right? Those type of things, and I think a number of interesting companies in that ancillary space are coming up. Even the battery, I think we've talked about BESS, right?
Yeah, yeah, correct. BSS, we've spoken about.
Yeah. And I think tires, I think so that pack is pretty attractive right now, and I think our strategies are really picking up on this pack. Then, talking about IT internet, I think right now, you've seen TCS earning come in. It was not very attractive. I think it was as expected. There were not expectation of high growth, and that's what happened. Um, I think it will be a muted quarter for internet and I mean, at least for IT, and that is because of the tension in the Middle East and impact on the travel, transport, and all these verticals, right? And I think stronger picks would be mid cap ITs compared to the larger cap ones. If you look at the hardware, which is electronic manufacturing, I think there are some interesting companies you see in Dixon and Keynes recover very strongly, right, after the ceasefire announcements over the past 1 week or so. You see, very strong movements in the EMS bucket, and I think that could definitely be interesting to look at. Even though I think there is going to be an impact on this sector also due to the geopolitical supply chain disruption. But yeah, I think the demand in the auto and industrial sector is increasing, and EMS is definitely quite interesting. Now, talking about FMCG, discretionary retail, right, these consumer sectors, we're not expecting very strong FMCG earning because of the elevated palm oil prices. Alcobev is interesting, right? I think Radico Khaitan has done really well. There's some
Yeah.
policy which is positive in this segment. The premiumization theme is impact. So Alcobev is interesting. Even in terms of retail, hotels, QSR, you'll see that there was strong demand domestically, right? And I think even on QSRs, the growth is healthy. So I think in FM in the consumer bucket, mostly premium, which is your Alcobev or QSR or hotels could be interesting points to look at. Talking about the building pack like cement, capital good, defense, infra, I think you're seeing strong growth in volume for cement, but I think crude oil will impact that earning. Uh, in terms of capital good and EPC, I think the data center pack, the pack like Cummins and different other sort of companies involved in that pack are attractive. We do have some exposure in this space also. I think defense is a structurally strong theme, right? The order books are very healthy. The mixed execution in terms of earnings, but I think it makes sense to hold. So we have a couple of defense stocks in our baskets. Logistics, which is export import, I think that will be impacted due to the global shipping and container friction. Let's talk about energy and real estate. I think Reliance would be steady, right? I think people are expecting 10% growth in terms of EBITDA. But yeah, I think there would be certain sectors of oil and gas which will see some impact. I think power energy is again a strong theme to look at right now. We've been holding some transmission stocks for a long time, which have worked really well even during the correction. Uh, so I think that is definitely pretty strong. I think with ethanol blending coming in, looking at some of the sugar stocks might be interesting. If you look at real estate and infra, I think the real estate proved to be very robust, right? And I think something that Siddharth you are talking about, which is the renewable equipment, right?
Correct.
Yeah,
I
because
think, yeah.
you go ahead.
No, no, go ahead, please go ahead.
And I was just saying that now that the oil and gas industry is so volatile, people will look at renewables, right?
For sure, yeah. I think also with I think data centers coming up and a lot more energy requirements for India. Also, I think you will need to diversify. I think
So yeah,
renewable could be a pretty strong player as well.
definitely. If you have chokeholds like Gulf of Hormuz, like the state of
Correct.
Hormuz, then you need more diversification, right? And I think equipment manufacturing companies in that space could be very attractive. Now, metal mining, if you talk about that, I think some metal stocks will definitely do strong, right? Uh, so that would definitely be interesting. I think Vedanta and National Alum, there's certain stocks where you see expect good numbers. On the other hand, people who are consuming those metals, right, like oil and gas, energy, power, those will see some negative impact. Right? And yeah, I think like you talked about Siddharth, like the fertilizer space, right? These will be impacted by the global headwinds, right?
Absolutely, yeah. I think
Specialty,
chemicals,
yeah.
even, yeah.
Specialty chemical is something I remember last year we had very strong positions in specialty chemical. I think right now we hardly have any positions in specialty chemical, right? Even
Yeah,
on the pharma space, you might see some. I think again in the pharma space they've raised that tariff recently.
tariffs, yeah.
Yeah, but there are certain stocks that are still going strong, right? Okay, we did talk about metal and mining and specialty chemicals, right? So you see metal mining to have a strong spot, and specialty chemical might see some impact. Another interesting thing that we're looking at is the home decor sector, right? I think piping, tiles, woodwork. I think there you might see some strong numbers through some stocks. So this would be a strong theme to look at. Uh, Then I think media and entertainment. I've seen a lot of reports written after Dhurandhar 2, right?
Mm,
I think that film is going to have an impact on like PVR Inox and I think other media companies. So yeah, I think so. So you see that across different sectors there are definitely buckets where you see impact of the geopolitics, right? For example, we talked about your oil and gas sector, cements, and capital goods, etc. Where you're seeing some impact, but there are certain domestic sectors which are still very strong. So our recommendation would be that first of all, have that core stable portfolio, and I think private banks definitely will be, and certain FMCG companies will be the core defensive uh, uh, allocation that people can have. Then you see your growth engines, right? I think we talked about the metal baskets and autos, which are doing extremely strong. So that could be the growth engines. And then I think there are certain niche companies, for example, Coforge or Radico Khitan or Aluwalia contracts, which are still doing extremely well. So I think that would be the way to play this, right? I think you have to be in different performance buckets. And yeah, I think what should we watch out for going forward? I think one would be the geopolitics, obviously. Second would be the commodity inflation, right? Which could have an impact on autos also. Then the AI disruption, I think that has taken a, we're not talking a lot about that given the geopolitics recently, but AI still is going to have a disruptive impact. And I think I'll be watching the IT earnings closely to see what the management is talking about the impact of AI. And then I think the policy shifts, right? I think that could also be something that you watch out for. So, what are the key takeaways? Earnings will be soft. There are disruptions from the global market, but there are bright spots on earnings where where we are seeing a lot of our allocation shift to, one being domestic mobility, financial assets on the credit side, and then metal space. And yeah, I think being defensive at this point in time, I think makes a lot of sense. So that is what I had to cover. So that maybe we'll quickly go over, our performance for last month, right?
Yeah, yeah.
Wait, I'll just quickly bring that up. Um, so here's the performance for last month compared to the benchmark. You can see that we were discussing it recently also, Siddharth, that because the big uh, mistake or the big sin that we did was in early last year, right, 2025, which was uh, which was hedging during that recovery period, right? Now
Correct,
that
correct.
is more than a year old. So on a year-on-year basis, our factor fund at least is outperforming the benchmarks. But yeah, I think we still have to make up for, I think, some uh, 7-8% underperformance that we built during that time, right? But on a year-on-year basis, you can see that we picked up, if in the short term, right, in 1 month period, both our strategy have outperformed. If Alpha actually has done better than the factor strategy, and on 1, 3, 6 months, all our strategy are doing well. What is very interesting to note here is that we didn't do very aggressive risk management, right? There was no period where we went out of the market by 30-40%. We did do tax loss harvesting towards the end of the month, which has had some impact, and I'll be very honest, because the market recovered around it, so we could have done maybe marginally better than this if we had, if the tax loss harvesting timing was better. But yeah, I think we see, what I was trying to tell you is that we have not done any aggressive risk management. We've not gone out of equities, or we've not hedged very aggressively. Very organically, the stock that we are holding, right, they are proving uh, to be strong, right? They are proving to be suitable for the current scenario, right? And that gives us a lot of confidence. So I think this one question that you get quite a bit, right? What happens when, what do you think, right? What about the recent performance, and what do you think? See, like I was saying, there was a period where we saw slightly sharper correction, and we hedged, where we could not see, we missed out on some recovery. But I think if you look at a year on year basis, our strategies are doing better than the benchmarks. And we have that confidence that we'll see. And I think, see, what is I'll maybe quickly pull that up, so that as well. Yes. So if you look at the recent performance, right, if last 1 year we have sort of tracked the benchmark, done better than the, at least if you go over the last 6 to 8 months, I think our strategies have done better than benchmarks. I think 4 out of 6 times, right? So I think that gives us a lot of confidence in our strategies. And what is very interesting is, to give you some context here, is like I was saying, last year we had a totally different allocation. We had a lot of chemicals, we had retail, which was a significant allocation. We hardly had any industrial exposure. Very organically, our strategies in September October have pivoted to more metal exposure, more exposure into autos, more exposure into auto ancillaries, like I said, more exposure into certain capital goods, right? And that is proving very strong, right? You can see the strength of recovery that we are seeing from the correction, and how strongly the strategy only with the equity allocation has held compared to the benchmark in the correction, right? So that gives you a lot of confidence on the allocation that we have, number one. Second is a lot of confidence in the ability of the strategy to adapt with the market, right, to pick the right set of stocks, right? And I think I will just take a few more points for ourselves, right, in managing this correction. Like I said, we did not do any risk management, which is the sin that we did last year. And I think that has proven very strong, right? You can see, we've seen a strong recovery. We've made up from the drawdown very sharply, right? And even in the drawdown, we did much better than the market, right? So I think it's a lot of positives in that sense, and I think a lot of learnings. And I think if the investors, I think one question that people will have is, what about the recent performance? What about, where do you see this going? I think, see, that's what this picture tells you. First of all, the allocation is so strong that it held strong by itself during the correction and saw such a sharp recovery once the correction was over. Second, I would say that the allocation pivoted with the market, right? So once the market shifted in the favor of metals, in the favor of autos, our strategy allocation shifted, whereas some of the static strategies will not shift, right, which gives you confidence. And third, on a year-on-year basis, you're seeing that our strategies are tracking the benchmark. In the recent month, you've seen more months of outperformance compared to underperformance. And yeah, I think like we said, that typically after such correction, you see strong pullbacks, and that's where the strategies like ours would shine. And yeah, I think once that happens, we hopefully will not hear any questions about underperformance anymore, right? That's the hope.
Yep.
Yeah. Quickly, if I were to, I'll just take you through where we are invested. So we are invested. You'll see a lot of consumer cyclicals, financials, certain industrials, metals, and pretty much in line with what our commentary was, right, based on what we're expecting from the market. So that is where we are actually allocated. And what's very interesting to that is we don't choose this, right? We never have a call or a thought key, right? Let's invest into metals, yeah, let's invest into financials, right? I go and talk
Correct.
talk on various, let's say, on various channels. I would go and talk about certain sectors, but we never take that decision. The strategies picks up those allocation, and you see how closely this matches up with the expectations from the market, right? And that is what gives us immense amount of confidence in our strategies, right? So our note to investors would be that just have that confidence in the strategy like we have. And yeah, I think you're already seeing you know the proof of it. And I think if people are looking to invest very honestly, the recovery that we are seeing, right, I think those are some of the strongest time to allocate in strategies like ours, which adapt to the trend with the market, which are able to capture the growth drivers. And yeah, I think our strategies could be actually very, very objectively one of the best places where you could take a position during this correction, right? So we talked about the strategy to allocate. One would be, and in fact, so that we're seeing a lot of our smart investors actually topping up, right?
Correct. Yeah.
Yeah. So we did send out a note around the end of March that this might be the best time to allocate, and it was so timely, correct? So
Correct.
see, I think,
Absolutely. Yeah. This was
yeah.
for our PMS investors specifically, but
Yeah.
yes.
Yeah. So we were somewhere around this, and we thought that this is the depth of the correction. And we were actually seeing certain people who are new to the market. They were jittery, you're seeing some redemptions happen, and we send out a note key, if you want to allocate, this is the best time. And many of our investors have made strong top up calls right during this time. I think that will prove to be very strong. So I think immediately, I think this is a great time to top up. You might see some more risk. I think negotiations are going on, so if there is another risk, I think that would be the second time to top up. And I think when the resolution happens, that is where your third top up could happen. So I think it's a great time to allocate to the market. It's very honest and objective sort of thing. I know we are a PMS provider, we'll always ask you to invest, or when we want you to invest, but then I think, or very objectively, the scenario that we're seeing right now is the best time to sort of allocate, right? So that is all I had. So that maybe we'll quickly go over the questions, right?
Yeah, I have about 10-15 questions for you
Wow.
today. Some of them we've answered, so we'll just touch upon it, and you can, just refer back. The clients can just refer back to the video. So the first question is from Mr. Finance Guru. He's asking, he was wondering if gold and silver still make sense to allocate to, given the volatility and the expected volatility until things are resolved in the next, let's say, 6 months to 1 year.
So it's very interesting that gold is now much more correlated to equities, right?
Yeah.
Ever since the you've seen that gold reach out to the top, and that is primarily because such risk scenarios which you see right now, which we saw last month, are the times when people's overall portfolios are impacted. So let's say you start losing money in equities, then you will go and sell your gold to get that cash, right? To maybe if you were leveraged, right? If you have to pay back the bank where you've taken a leverage, right? So such events tend to have very high correlation, and right now you're seeing gold move in tandem with equities. But I think, yeah, I think we do have. I think I have a positive bias towards the precious metals, and possibly in the next few sort of months you could see some recovery. So I would say that keeping some gold allocation might be prudent in this time.
Okay. The next question is from S. Mondal. They're asking, they're interested in our MF baskets, but those are not searchable very easily on the small case platform right now, given that they've newly been launched.
Mutual funds,
Considering
yeah.
its bonus and so sorry, the question just says, considering its bonus and increment season right now, which one would you recommend an investor to go for? He is 34 specifically.
Talking
Years
about the
of age.
mutual fund basket, right?
Yeah, yeah, yeah.
See, I think mutual fund baskets, in fact, a lot of people who invested with us on small case or even PMS, right? We do work on these equity strategies, but there are various investors who have confidence in mutual funds where they don't have to do a lot, right? It is a very much more passive sort of intervention from the investor. So the baskets that we have for you are one of the best ways through which you could allocate. So I would highly recommend that all our investors who have invested with us on the equity side could diversify on in the mutual fund baskets recommendations that we offer. And yeah, I think we have these baskets across different risk profiles. I went home, Siddharth, and I saw my dad and our neighbor, really take advantage of this correction, and they were looking to allocate to the mutual fund baskets. And so, people of slightly advanced age, you would recommend them to go with the moderate risk profiles, right, or the balanced portfolios. Whereas somebody like Somen, who is 34 years old, I think they could go much more aggressive. So looking at our aggressive or moderately aggressive basket might be suitable for him. And these are very cheap
Uh,
baskets, right? The fees
yeah,
are very
yeah.
not very high. You just find it on our website, or if you go to the rightresearch.in.smallcase.com microsite, you'll find all
We
these
have
baskets.
added the link on the chat as well,
Okay.
so people can look at it. Yeah. So this is a question from Mr. Sridhar Sunkaram. They're asking, given that the market is volatile along with the global political scenario, they're wondering, should they go for a small case or a or a PMS if they have that 50 lakh capital available?
See, I think again, that's a age-old question that we keep on getting, right? I think you could do either very honestly, right? I won't tell you to do one thing or the other, but yeah, I think with PMS, we would be much more mindful on how we allocate. So, like we said, we'll take a staggered entry, which is where your PMS manager would do that for you instead of you having to do that. And I think there is less sort of investor intervention or investor operational burden on the PMS side, which could be suitable for you. But I think either of them, right? I think on small case you have a lot of varieties of baskets where you can take allocation, etc. Right? Uh, so yeah, I think either of those things would be suitable. But yeah, I think on PMS we have these multi-factor strategies which could be interesting, right? I think that is one of the benefits. Or on small case we have an HNI basket, which could be interesting for you if you want to take like a one strong allocation. But yeah, I think either of those would be interesting, and I think what is important is that you allocate to a strategy which has focus on growth and momentum. In this scenario, where you're seeing a recovery, second, you go to a strategy which is much more diversified and dynamic, right? Which sort of moves with the market, also does asset allocation decisions, right?
Correct. So this is a question from Jay. Interesting one. They're saying, can you speak about the AI bubble that people were speaking about a few months back, and if you think AI stocks still have acceptable valuations to consider in the current scenario?
See, I think AI bubble, it's a very interesting sort of a point. I think, uh, so the fear is that one, that the AI stocks are overvalued, right? And some of the infrastructure. I think that's what Michael Burry keeps on talking about, right? This has parallels to the tech bubble,
2007. Yeah.
right? Yeah,
Yeah.
and stuff like that. I think there is some truth to it. I think it's not perfect in the way the allocation or the capex to AI has happened, right? There's a lot of mismanagement that could have happened there. So yeah, I think that risk sort of remains. And then the second thing, when people talk about AI, especially from India perspective, is that will Claude come and take away all the Indian IT jobs, which I think
Yeah.
is doing to a certain extent, right?
Yeah.
Uh, but yeah, I think Indian IT would sort of adopt. I think allocating to just the, what do you call it? Just these uh, these high, like OpenAI or Anthropic is not the only solution in AI. I think there's a lot of smaller models, open source models, which can do a lot of jobs. And I think Indian IT would sooner or later sort of adapt and take that space, right? And that is
Yeah.
where I would not just sell Indian IT short. I think the valuations in IT companies are very, very attractive right now. You could take some positions. But yeah, I think the capex frequency in AI and how that evolves would be an interesting thing to look at once the geopolitics gives us some breathing space, right?
Fair enough. Given that we spoke about IT, there's a related question that was there from Mr. Agarwal. He's asking, we've seen some sort of recovery maybe in IT stocks, or they've not done as poorly as they were doing maybe a
Hmm.
few months back to a year back, right? Um, uh, so where do you see that going, given one, the AI angle that was there, and now all of this geopolitics that's happening?
I'm sorry, can you repeat that?
So it's a broad question. They're essentially asking, where do you see the IT stocks going from where they are today, given the risks of AI, geopolitics, trade tariffs, etc., etc.
So where do we see the IT stocks going? I think see, firstly, you are seeing going to see a muted quarter this time. And I think maybe I think if you look at the projections for ITs, everybody has sort of built up that doom and gloom in the earning projections. But you don't know how these things evolves. You might see there could be some opportunities where Indian IT surprises on the positive side, and where you could see a bounce back in the Indian IT sector. There's a lot of talent in Indian IT, and there is a lot of I think experience, right? So I think the industry could quickly evolve, and that could have a positive impact on you know on the market, on the IT sector. But yeah, I think this there has to be a significant cue for that to happen. Right now, I look at IT stock as they have been protective during the drawdown. I think IT has been one of those sectors, right, which has been the cushion on the days when the market has corrected. So I would recommend that you could have some allocation to IT, and especially the mid cap names are doing strongly, right?
Which is interesting because I think earlier people were saying that maybe the large caps would do better given the AI shock. But yeah, we're seeing mid caps doing better right now. There's a question from Mr. Sandhya. They're asking, I'm not sure when this question was asked exactly, but they're asking why average returns and not median returns, given that the average is being influenced too much by outliers. I think maybe in the presentation we might have been speaking about in the drawdown portion, maybe the average returns that we spoke about in that blog, but I'm not sure what exactly.
Okay, okay. Yeah, I think he must be talking about the drawdown. Maybe looking at the average recovery from the
Yeah, yeah,
drawdown.
correct.
I think I mean, looking at average or median, I think won't. I mean, there might be some difference in a few numbers, but see, the essential idea is that there could be three types of drawdowns. One is the tactical or the short term one. Second is the liquidity one. Third is the structural one. We believe we are in the tactical sort of a drawdown, and these drawdowns are typically small in nature with a sharp recovery, right? And that is, I think, that is a very strong message that I really want to send out there, right? That wherever these strong structural drawdowns are over, you see strong pullbacks, right? And strategies like ours, right, which are able to allocate growth stocks. So Siddharth, let's do maybe uh, an overview of the feedback that we get from our investors, right? One is, so there are certain people who time and again, have some concern or the other about our strategies, right? Especially, when we did the risk management in 2025, I think that is the only pain point that people have. But you talk to any of the investors, people sort of really appreciate the type of stocks that we buy, right? So everybody has that confidence, right, that you guys buy the right set of stocks, you allocate to the right set of sectors, you're able to pick up the strong companies, right? And I think that is what works when you see correction from these levels, right? And I think our strategy are prepared. We are sticking very closely to our strategies. There's no excessive risk management that we are doing, and we are letting the strategies live their full potential. And I think such periods where you're seeing recovery from a tactical drawdown can be excellent places for a strategy like ours. And I think investors looking to allocate should seriously look at strategy like ours when they're allocating right now. So even if, let's say, I was to look at, if I was a very passive investor, I only invested in mutual funds, or if I only invested in ETFs, that I would probably, and if I had some risk profile, right, if I was not a very conservative investor, I would probably look at allocating to maybe a momentum or a mid and small cap sort of strategy at this point in time.
Makes sense. Um, so I've got two questions, and then we'll sort of move on to momentum. There's a few questions on it as well. One is, were you running higher than usual cash in the last couple of months leading up to the scenario that we're in right now? And are you hedging anything, or are we fully invested from a strategy perspective?
So we did two instances of risk management, right? One was that we hedged the strategy very early, right, to the extent of 20% of the portfolio value, right? So if you are hedging with 20% of the portfolio value, this hedge wasn't done for every investors, because the lot size for Nifty have increased quite a bit, right? So only investors with their single strategy value having more than 50, 60 lakh or something was the benchmark above which we hedged, right? And so that hedge we started at the beginning of March. We cut it somewhere in the middle of March, right? We cut it
Mhm.
before the, I think, in the middle of the correction. and
Mhm.
we were holding almost 10% cash throughout the whole thing, and around 8-9% gold in our factor strategy, very small amount of gold in our alpha. We had cash of the on the level of 10%, not more than that.
Mhm.
And yeah, I think see, around the end of March, right, we did tax loss harvesting, which means that we cut down some of the stocks where we had losses. So on that particular day, you saw the cash go up to 20-30%. And like I said, it could have had a slight impact on the performance, because we saw a rebound around those times, right? So we might have done better
Mhm.
by a percentage if we hadn't missed that. But I don't think a lot of impact.
Sure. And then the other question from the same person, Palak, is that how concerned are you about the scale of FPI selling that's been happening? I suppose for the last 1 year now, maybe.
Yes, I think the FPI selling has been very, very is massive, right? Like, you're seeing huge amounts of capital outflow from the economy, but you also try to understand an FPI's mindset, right? It's not because they think that India is a very unattractive country, or there's no interesting opportunities in India. In fact, there are a lot of companies in India that FIIs would love to invest into. But typically, in a FII, how that works is that there is a investment decision, which means how do I invest, right? How do I take allocation? And then second is the asset allocation decision, right? And they're typically separate, right? So
Mhm.
the while some investors might like certain company sectors in India, they might be attractive. The asset allocation decision right now from the FIIs are like, let's stay out of emerging markets, let's stay out of risk, let's go safe given the scale of the geopolitical crisis, right? uh,
Yeah.
so yeah, I think that is what we're seeing at play. But yeah, I think obviously there are another question to ask here, Siddharth, on top of it would be that there are certain other countries that have been much more stable, right?
Yeah.
For example, the COSPI, uh, or some of the Southeast Asian markets have been much more robust in
Yeah.
comparison to the
Mhm.
Nifty. And yeah, I think, see, typically when the Nifty is down and out, right, those are the times where you see interest, right? I think the FIIs are very, very sharp in the sense that they come in when they see undervaluation, right?
Yeah.
So I think might be an interesting time to for them to look at the Indian market.
Cool. So, I think there's a one or two questions on this. One, I think one of them could be on the PMS portfolio, but I'll take both of them up right now. Well, the question is broadly on the right momentum strategy, and the overall POV that you can have on that. I think it has seen some sort of maybe recovery or correction in the last few months.
Mm-hmm.
Along with that, also on alpha, there's a question where they're asking, and I think this is more on the PMS side, maybe. What is the expectations on that as well?
So on the momentum strategy, I think it has, obviously momentum. Every strategy has seen that impact, right? In fact, so
Yeah,
on small case, our best performing strategy that wasn't momentum. In fact, was innovation, right? For the longest time.
innovation. Yeah, yeah,
Yeah,
correct. Yeah,
innovation, which allocate to the digital and to the new age technical sort of companies. So that did really well. Then obviously that sector has seen impact, right, due to the AI concern, etc. But then it's also seeing a strong bounce back. We have a new India basket which also saw some impact, but seeing a strong bounce back. So I don't think it's one strategy or one thing. I think the impact has been there, but you're seeing very strong recovery across the baskets, right? So I'm not concerned about any of those. Um, yeah, I think see, it's the nature of the risk management. We did go to almost 10% cash and somewhere gold in some of our strategy. I think in the balance
yeah,
strategy, which is more asset allocation based, there you have 10% cash, 10% gold. Otherwise, you had 10% allocation across your small cases. But yeah, I think we will sort of bring that back soon. Even on alpha, I think alpha has been very robust, right? If you look at our alpha strategy, right, the performance definitely has been quite robust during this whole period, right? uh, Even on if you're talking about alpha on the PMS, again, last month, a month before that, the strategy has been much more robust compared to the market. If you're looking at, in fact, if I look at April, Siddharth, right, our
Mhm.
alpha strategy is up 10%,
Yeah.
10.3%, right, in April itself. So it is getting its groove back. We are not interfering with the strategy, and I hope April is one of those months where you have alpha giving these absurd returns that make it a attractive strategy.
There's a question here from Mr. Deepak. They're asking, I'll take another three, four, and I think we'll wrap it up at that point. Mr. Deepak is asked about, I think, the new PMS dashboard that we have,
Mm-hmm.
and he's seeing potentially slightly different numbers from the previous one. I think the portal that is there. So they're
Mm.
just wondering what to do in that case.
The source of the
So I think
numbers
they
is
can
the
just drop us a message, maybe,
yeah. So
right?
using that dashboard itself, there is a very neat sort of place where you can send us a message through the dashboard itself, right? So just send us a query. I think I received two, three queries apart from this on the numbers, right? And
Mhm.
I think Siddharth, you also pointed out when we were doing the internal review, right? See, these
Yeah,
numbers
yeah,
are
yeah.
coming from the dashboard itself. I think the presentation of it, there's some plus minus. We'll just reconcile them and we'll get them together. But and
Fair enough.
sometimes
One. Yeah, sorry.
yeah. So one more thing is that so there are different types of return. There is time weighted return. There is rate of
Yeah,
return.
yeah,
There
yeah.
is this, that. Sometimes there are differences due to that.
Yeah. This is on the industrial exposure that we were speaking about in our portfolios, right? Given that the disruption has happened in the last 1 month also due to gas shortages for industrial production, how do you look to align the portfolio with that nuance there?
So see, we don't have a lot of exposure on the gas side. We do see if I look at the industrial portfolio that we have, I'll just quickly have a look at that, and I won't share that on the public channel. But yeah, see the type of allocation that we have is there in certain industrial manufacturing, industrial ancillary space. You have um, let's say pipes and tires and tubes and stuff like that. There is a some exposure which is linked to uh, your energy infrastructure, which is doing pretty strongly, right? So that is the type of, and I think our model also categorizes some of the defense exposure that we have into the industrial basket, right? So we do have some defense exposure which is also categorized. I think we have almost 10-15% defense exposure in that industrial basket.
Um, One, again, we're going back to momentum. Probably one of the last questions we'll take. Uh, they're asking about the momentum strategy. Where do you think it is less risky to follow momentum strategy, or buy on the dip right now?
See, I think it's very difficult to answer that question, right? How can you answer that
Yeah,
question, right?
yeah, yeah, yeah.
What I would tell you is that like I said, I think a very interesting strategy, and again, we saw this. Other strategies also discuss this, that right now is a great time to top up if you want. You can wait for maybe some, and if you see any more volatility coming up, that could be a good time to top up. And thirdly, when you see the Gulf of Hormuz running at 100%, then please put all your money in, right? So there will be a lot of interesting times to top up. You can also do a simple SIP if you don't want to do all that, right? That is what.
Okay. Yeah. So I think we can wrap it up there. We're getting one or two more questions, but I think they're similar in nature, so people can just go back and watch the live, and you'll probably get most of your answers there.
Awesome. I think this is really great. I think really appreciate people joining us on Sunday, spending so much time with us.
Absolutely. And I think what we'll try to do is we'll try to make this a regular thing. I think we just fell off and maybe in the last 1 or 2 months, but we will
Hmm.
try to do this every month going forward.
Perfect.
Great.
All right, guys.
Thank you everyone for joining. Yeah. Great. Have a happy weekend.
Thank you. Bye.
Thanks. Bye.